Let's be honest, none of us started a business to do bookkeeping. But without it, most businesses don't last very long. So let's go over the bookkeeping basics for small business. What is it, why it's important, and how to do it in a few simple steps. And I'm talking as simple as smashing the like button for the YouTube algorithm. It truly helps the channel. Okay, let's get right into it. Starting with what is bookkeeping and why is it even important? So, the textbook definition of bookkeeping is the systematic, routine method of retrieving financial information, categorizing that information, inputting it into an accounting system, and generating reports that are then used by decision makers to make better financial decisions in the future. Yeah, here's a definition you can actually understand. Bookkeeping is the recording of past financial data so that you can make future business decisions. So, how can you perform the bookkeeping duties for your small business? Well, all it takes is a simple 6-step bookkeeping process. And step number 1 is to gather source documents. Source documents are original records for a transaction. Things like an invoice, a sales order, or receipt, for example. All of these documents have a date, a buyer and a seller, an amount, and the product or service that was provided. Now, most people don't keep physical copies of their source documents. Instead, they rely on bank statements to tell the story. In most cases, bank or credit card statements have all the information needed to substantiate a transaction. But keep in mind that cash transactions are not recognizable using bank statements alone. And if you have a cash transaction, you have to retain the physical receipt or recall the purpose of the transaction to correctly classify those types of transactions. So, as a tip, it's good practice to use a debit card or a credit card to make and receive all payments. This way, you or your bookkeeper can rely mostly on your bank statements to classify transactions, making step 1 extremely easy. Step number 2, categorize your transactions. Classifying your transactions into a specific category is the core of the bookkeeping process. And there are 5 main categories that transactions can fall into. You have assets, liabilities, equity, revenue, and expenses. And each of these categories can be broken down into further subcategories, like a subcategory for inventory under assets. And the first step in categorizing is to identify which category a transaction belongs to. Like cash would be an asset. Future obligations like payroll or a loan would be considered a liability. Equity increases with revenue and capital contributions, and equity is decreased with distributions and expenses. The sale of products or services would be considered revenue, and the cost to generate that revenue would be considered expenses. So, to help with the organization and categorizing of transactions, I would recommend you use a software like QuickBooks. Step number 3 is to reconcile your transactions. A great bookkeeper will reconcile their transactions to make sure each and every transaction is accounted for. And this idea of reconciling is actually pretty simple. It's the process of matching all of your transactions that are on your bank statement to what's in your accounting software. And when you're dealing with hundreds and thousands of transactions, it can be pretty easy to double count a transaction or two, or simply miss one. And reconciling helps catch all errors. You start with the beginning balance on your statements, which should match what's in your accounting software, and then check line by line to make sure every transaction is accounted for. Step number 4, prepare financial statements. The process of adding, classifying, and reconciling your transactions provide the input for financial statements. And there are 3 main financial statements that should be prepared: a balance sheet, an income statement, and a cash flow statement. Your balance sheet is also known as a statement of financial position. It contains assets, liabilities, and equity transactions. The assets on the balance sheet must equal liabilities plus equity. If not, your balance sheet is out of balance. Your income statement is also known as your profit and loss statement, or P&L for short. It contains your revenue and expenses. The income statement simply tells you how profitable you are at any given period. Now, your cash flow statement has 3 components: cash from operations, cash from financing, and finally, cash from investments. The cash flow statement shows how transactions from the balance sheet affect your cash account. All right, let's move on to the last 2 steps. Step number 5 is to read your financial statements. So, you prepared those financial statements. Now what? Most businesses fail or succeed based on their financial statements. Therefore, it's critical that you review your financial statements, understand your financial statements, and take advantage of the insight they provide. This key action is the difference between you having a more profitable business this year than you had last year. And in order to read your financial statements, you should understand how they're structured. So let's look at the structure of a balance sheet. Remember, the balance sheet must balance. Assets are listed first, and liabilities and equities are listed last. Now, assets are ordered in terms of liquidity, or how long it will take for that asset to convert into cash. And for this reason, cash is always the first thing listed under assets. For this reason, cash is the first thing you will see on a balance sheet, followed by other current assets, like accounts receivable and inventory. Now, long-term assets are listed after current assets, and fixed assets like equipment take into consideration depreciation, something called a contra asset that would reduce the asset side of the balance sheet. And you can think of depreciation as the amount of an asset that has been used up. Now, the liabilities section is listed similar to assets, where current liabilities show before long-term liabilities. Current liabilities are debts due within 12 months. Common accounts listed under liabilities are accounts payable, wages payable, and credit cards. Common accounts listed under long-term liabilities are things like bank loans, car loans, and capital leases. The equity section is listed last on the balance sheet. It shows the ownership in a business. It's sometimes referred to as the book value or the net worth of a business, since its value equals assets minus liability. Also, retained earnings is a section under equity. Retained earnings are the dollar amount of earnings reinvested back into the business. All right, we're making progress. Let's look at the structure of an income statement. The first component of an income statement is revenue, aka the top line. It's the dollar amount of products or services sold at a given time. The revenue section can be broken down further into specific types of income based on the products and services that are sold. The next item is the cost of goods sold, or cost of sale. These are the direct expenses associated with selling your product or your service. Examples are inventory cost or labor. The other expenses of the business are listed below gross profit. And the bottom line of the income statement is called net income. It's the amount after subtracting all expenses of the business. It answers the question, what is the profit or the loss of the business? Now, let's look at the structure of the cash flow statement. The cash flow statement tracks the cash coming in and out of the business. These cash inflows and outflows are broken into 3 categories: operating, financing, and investing. Cash flows from operations are the cash activities related to performing the everyday, regular, ongoing activities of the business. Activities like selling products or services would be considered cash flow from operating activities. Now, cash flow from financing relates to capital raising activities of the business. When your business starts repaying the loan, that is considered a financing activity. And financing activities don't just account for loans, they account for equity too. So if your business issues stock to investors, that is also a financing activity. Cash flows from investing simply relates to the gains and losses from your business investments. When your business buys stock in another company, that is considered an investing activity. Now, the final step in the bookkeeping process, step number 6, is to make decisions based on the data. Remember, the purpose of bookkeeping is to help you make better, more profitable decisions. The balance sheet outlines your company's assets, liabilities, and equity, which means the balance sheet can be used to gauge the liquidity and sustainability of your business. Let's use an example of a company that has $1 million in net income. Their balance sheet shows 3 months of income in accounts receivable. Knowing this information, the owner might decide to shorten the collection period to have more cash on hand. The income statement tells you the operating performance of your company. It lists out the revenues and expenses and spits out a profit or a loss. The cash flow statement tells you how much cash you have on hand. If your operating cash flow decreases, then you might reassess some of your operating expenses or even your pricing. In short, bookkeeping can be the difference between you having a more profitable year this year than you had last year, simply because you now have accurate data to make smarter decisions with. So if you haven't already, go ahead and like this video for me. It helps other business owners to see this video. And subscribe to the channel for more information that helps you save on taxes and build your business. I'm Karan from Life Accounting, and I'll see you in the next video.